Everyone, I'm Giovanna here with Hassan, and today we're exploring a big question: why VC doesn't work for most founders. Let's start with data. How successful are VC backed startups compared to those who do bootstrap? What do the numbers really show?
So, VCs aim for unicorns. They want a company that can return 10x, 50x, or even 100x of their fund. So, as a founder, you're under a lot of pressure to aim really high and scale massively. According to the Harvard Business School, about 75% of venture-backed startups fail to return capital to investors. So, these investors know that most of their investments are not going to work out, uh, and they're also really hoping that the one that does is able to make enough money so that they can make back all the money they lost on their other investments, which means they put a lot of pressure on you to be big or fail trying. And these companies, uh, you know, according to another report by CB Insights, only 10 to 20% of venture-backed startups actually achieve significant success. David Friedberg, who's a really successful entrepreneur and one of the hosts from the famous All In podcast, mentions that the chance of building a startup valued at over $1 billion is about 0.00006%, which is extremely rare. And importantly, there's like a 67% chance that founders will make nothing at all financially from their startup. In contrast, bootstrap businesses or other small businesses are often more sustainable. According to SBA data, 50% of small businesses survive more than 5 years because these companies often aim for profitability early and aren't forced to scale prematurely or grow at all costs.
The probability of startup failure significantly outweighs the chances of success. So, why do VCs prioritize growth so heavily? And how do their incentives, both their own and those of their limited partners, differ from those of the founders?
You take venture capital, you're basically signing up for the hyper growth incentives and expectations that VCs have from founders. And there's some things that as a founder you need to be aware of when you're dealing with VCs. VCs are not your best friend. They are portfolio managers. They're not company builders. Their job is to raise money from limited partners or LPs, like a big pension fund or a university endowment. And their job is to raise money from these LPs, and they're expected to double or triple that LP's investment in their venture fund over 10 years. So that pressure is what sets up the VC's own incentives, and that's sort of what guides the VC's relationship to you as a founder. So it's not inherently bad; it's what the VC model is designed for. Most VCs, they require they're required to be focused on those companies that have the highest earning potential, like the billion-dollar companies. But from a founder's perspective, if you're building a great business that can be worth $10 million or even $50 million, that's not a big win for the VC because the VC is going to lose most of the investments they do in their other companies. So they really need you to be a billion-dollar company for their 10 or 20% stake to make up for all the failed investments they do in other companies. So this is a really important caveat to understand between the difference of venture capital incentives and the founder's incentives. A founder might be very happy with a $20 million company. A VC for sure is not. And the VC's incentives are tied to finding one or two mega winners, not in helping every founder succeed or helping every founder in their portfolio build a solid, profitable business. If there's a portfolio of 20 companies, the VC only needs one or two to be unicorns to make their entire fund look good and make their money back and make a return for their investors, which is the LPs. The rest of the companies, they're just collateral damage from the VC's perspective. And when you take money from a VC, you're also tied up to burn cash fast for faster growth because VCs want you to grow your company fast, so that they can go to their LPs and say, hey, all my companies are now growing really fast. Give me more money for my second fund. And so that's a bit about how the VCs are structured, incentivized to push for faster growth so that of the 20 companies in their portfolio, one or two become a unicorn. And the others, if they die trying, that's pretty okay from a VC's perspective, but that might not necessarily be the same case if you're one of those 18 other founders who are not only going to be a unicorn, but maybe you could have had a 20 million or $50 million good business. The VCs aren't just going to guide you in that direction, and it's really important for you to be aware of that.
So, founders often stake their careers, their savings, and their well being on a single venture, while VCs spread their risk across an entire portfolio. What specific risks do founders take on when working with venture capital, and how exactly do VCs diversify their risk?
Primary frustration I see is this fundamental misalignment of risk and reward. So VCs are quite rightly diversified across their portfolio because they invest in a portfolio of companies, which is good for them, and they have that's it sets them up to be able to recover their invested amount. From one or two companies, and that's how the VC model works. But that's not necessarily how a founder is structured because the founder isn't really diversified across a portfolio. A founder is all in on their company. So VCs will diversify across 20 to 30 startups in a fund, and their losses from most of their companies, as we talked about earlier, doesn't really threaten their business as long as one or two of them can have a high impact. But from a founder's perspective, the founder's entire financial and emotional well-being is often tied to this one incredibly high risk bet. Founders are betting their entire career, their savings, even their family stability at some point. The data on this is really eye opening. 65% of startup founders reported spending less time with their families, while 85% said they had experienced high stress in the past year, including mental health issues like anxiety, depression, and insomnia. According to a set of data by OpenVC, at the pre-seed level, salaries for the average founder are around $50,000 or even lower, which is a really large pay cut compared to what these founders would be earning if they were continuing with their sort of job that they had before they went towards being a founder. And this is only after they've raised pre-seed funding. So before you've raised any funding, you're pretty much on your own. Uh, Another thing that founders should be aware about is equity dilution. Equity dilution in the venture capital business is something you can't really control. You start off with 100% of your company, but each funding round typically shaves off 15 to 25%, sometimes even more. It's not uncommon for founders to own less than 10 or 15% of their company, the company that they start, by the time of a modest exit. And if a company fails, the founder only walks away with years of lost income and hard work. They do get some really valuable learnings, but from a risk to reward perspective, the VC has a lot of diversified risk. The founder does not. According to another set of data, 70% of startups are affected by venture capital timelines, and the pressure can force them to make mistakes like scaling prematurely, hiring too fast, spending too much money, or shifting focus away from sustainable growth towards sort of rapid exits and rapid acceleration. A failed startup can mean financial ruin for a founder, but for a VC, it's just a tax write-off. And a quote that I really like about this is from Jason Fried, CEO of Basecamp, one of the most successful bootstrap founders, when he said that VCs want you to swing for the fences because they need only one or two huge exits, and they don't care how many companies die trying.
Thank you so much. That was really impactful. So VCs often pressure startups to grow fast, which can cause founders to lose control over the vision and their ideas. If venture capital isn't always the right fit, what alternative funding options should founders consider? And for those who do pursue VC, how can they set themselves up for success?
Most underrated path is bootstrapping. So bootstrapping allows founders the freedom to make their own decisions and sort of independent control over their business. Founders only answer to their customers and their own vision, not to external investors or their timelines. This naturally allows incredible capital efficiency because every single dollar spent has to be justified by direct customer value or sort of a clear strategic vision from the founder's perspective, and you get to be in charge of making those decisions based on your long-term goal of your business, not some VC's opinion. The growth might be a bit slower, it might be more organic, but the focus is squarely on building a profitable, sustainable business from your day one. It's well suited for companies that don't require colossal upfront capital for R&D or massive inventory buildouts, or sort of hyper aggressive, acquisition and market capturing strategies. And it's a great foundation for raising venture capital later on as well. Some wildly successful companies like Mailchimp or GitHub were bootstrapped first and then decided to raise venture capital. Another option is to use revenue from your customers, also known as revenue-based financing, or even money you might earn from a job you are doing while you launch your startup part-time. Working part-time allows you to validate your core business idea and build out your minimum viable product or your MVP without taking on all the risk. You can acquire your first few customers, without abandoning the financial security or stability of a full-time job. And you can test your hypothesis with minimal financial costs on your side and really reduce the personal stress in your life. When your project starts earning enough to cover your salary or shows strong signs of product market fit, like it looks like this is working, that's the right time to go full time. This strategy sort of lowers your personal risk and makes you more attractive to VCs, since you can now show them real data and revenue that proves your business's potential, and not just an idea. If and when you do decide to raise venture capital, the key to success is traction. Traction or data that validates your business idea is the most important thing. If you can build traction before you raise money, you're in a really good position because you have real users, revenue, retention data. You're not just pitching an idea, you're showing proof that your business works, which really lowers the risk from your own side when you're trying to go pursue this full time. And it also boosts your chances of raising venture capital because you're a far stronger candidate when you do approach these VC investors. For startups, demonstrating traction matters more than simply chasing VC funding. Instead of emailing or calling 1,000 VCs, asking them to invest in your genius idea, if you contacted 1,000 potential customers and gained real traction, you'd be much more likely to raise venture capital from investors.
Bootstrapping and gaining real traction can prove your business's value, lower risks, and put you in a stronger position for funding. If I were a founder and didn't want to pursue the typical VC route, how could HBF Venture Accelerator help me build my product and provide me with the support I need without external investment?
Great question. So what we would say to you is don't chase VCs because it looks cool and there is the promise of funding. Chase customers, chase product market fit, and chase profitability or early traction, because that's what helps you succeed in your business, and that's what helps you succeed in front of VCs. The feedback we often get is, look, but I need capital to build my product. If I don't have a product, or if I don't have at least an MVP, how can I get customers, or how can I validate my idea? And that's where our accelerator comes in. Our focus is on helping founders launch their minimum viable product or their MVP, which is sort of the first bare bones version of your idea that you can test out with real customers and get real traction. And we help companies launch their MVP for just $75,000, $50,000 of which we are willing to provide in funding for that development. We believe that founders who have launched an MVP with real customers are not only more likely to succeed in their business, but we think they're also much more likely to raise venture capital when they do choose to pursue it, and they'll have a lot more leverage when they're dealing with these investors. So first thing is to build your MVP and get real data. We're happy to help you do that. We'll put in 50K to help build your MVP. And once you have that MVP and you have data that validates your business idea, that's when you're set to be successful as a business, and then also as a founder who decides to go raise venture capital in the future.
All right, everybody, and that's a wrap. Thank you so much for listening to me and Hassan talk about why VC doesn't work for most founders. We'll see you next time, and thank you so much for listening.